Welcome to the second video on Chapter 3. We're going to talk about the financial markets and how to trade, how to enter orders, different types of order types. First of all, the importance or the critical element of financial markets is liquidity, which means financial markets provide a ready place to buy or sell. There are always, hopefully, the goal is there are always buyers and sellers available for you to trade with. So if you want to buy shares, there are sellers available. If you want to buy, then there are sellers of trade available. So, and also the scale of financial markets creates low cost. And the cost of trading has been declining for decades. It continues to get lower and lower, even down to zero on some platforms for small trades like Robinhood. This slide lists some of the market types that are out there. There are a variety. First of all, most financial institutions that provide trading services are both brokers and dealers. So they're called broker-dealers. And they broker transactions by putting together buyers and sellers. And in their dealer function, they maintain an inventory and will buy or sell out of their inventory with their customers. Auction markets are becoming more and more, much less, commonplace. So these are the markets you've seen on television shows and movies with the various participants wearing different colored jackets and shouting out, holding up signs and making hand signals to buy and sell. That is much less common as we move more and more electronic. So there's different ways to enter a market, enter a trade whenever you want to buy or sell. There's a market order, a limit, and a stop order. First of all, you should know that the market order just is a transaction an investor would enter that you want to happen right away at the best price available. And that's called a market order. No strings attached. You enter your order to sell your Apple stock and it executes. And the transaction's made, which again speaks to liquidity. I mentioned a little earlier. I mentioned the great thing about markets is there's many buyers and sellers, so there's someone to buy your Apple stock. And what liquidity means is that you can convert it to cash quickly because of that fluid market that contains many buyers and sellers. You should know the difference between the bid and the ask price. Now, remember, and I tell students, think of this from the dealer's perspective, not yours as an investor. So what is the dealer or the broker bidding? And what are bidding for what you have? What are they asking for what they have in their inventory? So again, a dealer keeps a balance sheet. They may own a variety of stocks that they will sell to you, or they may buy your stock, whatever securities they make a market in, at what they're bidding. So if they have a bid price, they will buy it from you, put it in their inventory at their bid. And the difference between these two is called the spread, and that's the dealer's profit. So they will buy at the bid, sell a little bit higher, what they're asking, and earn the difference, the spread. So what is a limit order? A limit order is when an investor would use a limit order when they're looking for the best price they can get. For instance, if you want to buy a stock that's trading, $10, $11, you may place a limit order to buy it at 10 or lower. Or you may place an order to sell it at 15 or higher. So you're looking for the best price. A stop order is a little different. With a stop order, you're looking for, it's sometimes called a stop loss order because you're just looking to get out of a position. Perhaps you've bought a stock for $10. If it drops to 9 or less, you don't want to own it. So a stop order means sell it at the 9 but even if it drops below 9, you would still sell. A limit order means you want 9 or higher. A stop means you'd like to get 9 or higher, but you'll take below 9. Okay, so it's a tool used to limit your losses primarily. I suggest you get familiar with stop orders and limit orders. This slide kind of summarizes that. You may have to read a little bit beyond this in the book about it. But if the price falls below the price we wish to get, we would have to use a stop loss order in order for our trade to execute. If the price goes above the price we wish to get, we would have to use a limit sell order for that trade to execute. So this is the limit order book on an exchange called BATS for Facebook. BATS is an electronic communications network. It's all electronic, works over the internet. So the limit order, remember, limit orders are when investors want a particular price or better, more favorable to them. And the order book lists prices from the most favorable to an investor to the least favorable. So the bid price is the price that the dealer is bidding for stock that he will or she will buy. So the highest bid, well, look at this. This is actually another little mistake in the book. This should be a 9 right here. 149.75 is the highest bid of any of the dealers on this network that they will pay. And this dealer's offering to buy 50 shares at 149.75. And then you can see that the prices decline after that with various lot sizes. And then for the ask, this is what dealers are posting, that they're asking for what they have. So the lowest price is listed first right here, 149.76, and then prices go up. So on the left side, the prices go down, the right side, they go up, because the most favorable price is listed under each column. So that's the way order books typically work, whether it's at BATS or else on another exchange. We'll talk more about BATS in a minute. So again, this slide talks about average market depth. That is the total number of shares that are offered at the best bid and ask spreads. So the more shares that are offered at the best prices for investors, the more liquidity the market has. So you can see that this line right here is the S&P 500 firms, the 500 largest on the New York Stock Exchange. And there's far more shares offered than on smaller companies down here. So you could say that the S&P 500 firms have much more liquidity. There are more shares available at good prices for purchase, and more shares available at attractive prices for sale if you have shares you want to sell. So it's large company stocks that have more liquidity, and that's a positive for investors. So this slide is about various approaches for trading. They call it trading mechanisms here, or how securities actually trade. And there are 3 types. There's dealer markets, there's ECNs, or electronic communication networks, and specialist markets. And you're going to see examples of both. So dealer markets, where their dealers maintain an inventory, is called over-the-counter market, or OTC. It's also called the NASDAQ market. And both of these are platforms where brokers and dealers are linked together by computers and post their bid and ask quotes for various securities, different stocks. And then there are similar type of platform are ECNs that are also computer networks that allow direct trading between individuals. The specialist market example is the New York Stock Exchange, and in that case there is a an individual assigned as a specialist to maintain a fair and orderly market in one or more securities. Typically, a specialist will manage several different securities and make sure that buy and sell orders are matched up fairly and in an orderly process. The next couple of slides provides a little history about how the markets have developed. One of the things that I think is important is to note that SEC, in trying to make the markets more efficient and inexpensive, dropped the minimum tick size in 1997. Now the tick size is how much a commodity or a security moves at a time, the minimum amount it can move. And before 97, that number was 1/8 of a dollar. That's 12.5 cents was the minimum. Today, stocks trade can move a penny or even less. At that time, if they moved up, they went up 12.5 cents, minimum. And then in 97, it dropped to a 1/16, which is 6 1/4 pennies. And then in 2001, the minimum tick size dropped down to a penny. And I've seen trades today that execute at less than a penny. So, SEC is trying to make the markets more efficient and investor friendly. And you can see that the spread, which I mentioned before, the spread is the profit to the dealer. And you can see that the spread fell as during each period when the markets traded. The New York traded at 1/8 of a cent, and then here, and then to a 1/16, and then down to the decimal. Spreads are profits to the dealer. You could also say that's transaction cost to the investor, fell each time minimum tick size was reduced. So that was a positive for investors. So this slide gives you a little information about some markets in the United States. NASDAQ now has about 3,300 firms. The New York has fewer, about 2,800, but they are larger firms on the New York. And the NASDAQ has more trades per year. There's more trading activity, but again, there are smaller companies typically. Also, an important issue on ECNs is latency, and latency is a computer term for the time it takes for a computer demand a command to execute. In this case, the time to process the order and for that to execute. This is an interesting slide because it is looking at New York Stock Exchange listed shares where they trade. So companies, when they go public, list on a particular exchange. In America, usually they'll list on the New York or the NASDAQ. But even though they're listed on the New York, they may trade on other exchanges as well. And New York listed exchanges, you can see right here that a lot of shares trade on the New York, but there's the other category. Actually, what's listed as other here, there's more shares trade hand. The market share is greater on some other exchanges, miscellaneous, besides New York. The biggest part of that is something called dark pools, and we'll talk about that more in a second. And third place here is NASDAQ. A lot of shares trade on NASDAQ that are listed on the New York Stock Exchange. So this slide talks about they're not brand new trading strategies, but algorithmic trading, or they're called algos, are when the quantitative firms, computer specialists build programs that they build in the conditions that they're looking for a trade to execute, and then the computer actually enters the trade. It's another kind of term for the same thing is high frequency trading. It's kind of taking the space the space of the day trader. So the day of people sitting in front of a computer and buying minute to minute and making a living from home has really shifted to, journalists that sell books. It's really difficult to day trade anymore at a profit. Really discourage you from doing that because computer programs are entering buy and sell orders for, they may buy and sell a second later for a fraction of a penny. So, and these high frequency trading firms, Renaissance Technologies is one of the most effective. Year after year, they have the highest profits in the hedge fund industry, off the charts, 20-30% a year, by scalping fractions of a penny. And the people that work at Renaissance and other high frequency firms, they employ PhDs in statistics, astrophysicists, and all sorts of quantitative mathematics PhDs. So you're up against some really difficult competition if you think you're going to make a living at day trading. Not a good decision. Really discourage that. We have a better edge. Our edge as individuals is really in long-term investing, but would not look to be in and out in a few days or even a few weeks. Difficult. I mentioned dark pools a few minutes ago, and dark pools are places that large participants, see, 10,000 shares minimum can be traded anonymously. So dark pools are used by institutions and very, very wealthy individuals, sovereign wealth funds, which are funds owned by nations. And that made up, you'll recall, the largest percentage of shares traded on the New York Stock Exchange, predominantly dark pools. I mentioned a few slides back that the New York Stock Exchange is the largest and most important exchange in the world. And that's because when you look at the market capitalization of exchanges, they far exceed their competitors here. So I want to remind you, market capitalization or market cap is all the total number of shares a company has multiplied by the current price of those shares is called their market cap. And the total of all the market caps on an exchange shows you that there's quite a bit of difference between the New York and second place contender, which happens to be the NASDAQ. And then we move to Japan and so forth. So the non-American exchanges are typically considerably smaller than the American ones, much to our favor here. Trading cost. One of the areas that you would be at a disadvantage against a high-frequency trading firm are trading costs. They can trade at very low costs, which gives them an edge, an advantage. And there's two primary costs. One are commissions, which is just a fee for a transaction. It may be for a full service broker, you may spend hundreds of dollars for a commission on a transaction. The other is the bid-ask spread I already talked about, which is the ask minus the bid is the spread or the dealer's profit. It mentions here that some trades both a commission and a spread may be paid. The SEC is creating a pressure to eliminate that kind of double dipping. A lot of firms don't allow that anymore, that you're either going to earn the spread or the commission. So yeah, costs can add up and can really impact the profits of a speculator, which is another term for a short-term trader. So we're going to end this video right here. We'll pick up in the last video on this chapter and talk about margin trading and selling short. A couple of fascinating areas for you. In the meantime, I want to remind you, if you want to build some wealth, gotta live below your means. Spend less than you earn. Save some money. Then learn about investing and invest it carefully, and you'll retire a lot better shape than your peers. See you next video.